Hello everyone and welcome to this session where we would be discussing about AS29. Now this is again a standard which is quite a bit case based, and hence from an exam perspective we'll understand the law, but it is more important to practice the questions over here to kind of take care of the variety of the different possibilities that can come. So we'll quickly go through the theory for AS29 and then we will go to the sums. So AS29 is on provisions, contingent liabilities, contingent assets. Largely, when we look at this standard, it is a standard which pertains to liabilities. Now, most of the standards that you've studied till now, whether it is PP, intangibles, investments, inventories, borrowing cost, all of these largely pertain to your accounting, let us say, for assets. However, there are also liabilities in a balance sheet for which there are a few standards which are dedicated, like you have employee benefits, AS15, which is on liabilities connected to employees. You have AS22, income taxes, for liabilities connected to tax. But other than that, there is no other accounting standard which specifically caters to the liabilities. And as a result, when we look at AS29, this is a standard for residual. Everything else which is not covered, every other liability which is not covered under a specific standard will be covered over here. And as a result, we need to understand what is a liability. Like when I look at an asset is a resource controlled by the entity due to past events which is capable of giving a future economic benefit. Now asset gives a benefit. On the other hand, a liability results in an obligation. So when we look at an asset, it is a resource which gives benefit. On the other hand, a liability is an obligation which results in outflow of resources. And as a result, this is first we figure out what is the meaning of a liability. Like when you look at a loan, there is a present obligation. The word present obligation means the presence, that is existence of an obligation. Do not confuse it with as present obligation means immediate obligation. No. If you take a loan which is repayable after 10 years, you are under an obligation to repay the loan. The obligation is present, but the obligation is not immediate. That is, you don't have to repay the loan immediately. Present obligation means the presence or existence of an obligation. Obligation is something where you have taken a loan or you have done a credit purchase whereby you are under no realistic alternative but to eventually pay for it. And as a result, there will be an outflow of resources because you have taken an obligation which is arising out of an obligating event. Now, there is a lot of high-end English used over here. We don't have to write down all of these high-end English words. We can explain in our own words as well, but largely we are going to get cases, not direct theory questions. So this is regarding liabilities. Now, usually when you look at liabilities has a present obligation. That means the existence of an obligation. The presence of an obligation comes out of an obligating event. An obligating event is an event which gives rise to the obligation. That obligating event can be taking a loan, can be doing a credit purchase, can be in case of warranty when you sell goods where you agree to repair them free of cost within, let us say, a specified period. There is an obligation to repair which arises the moment you make the sale. Yes, these obligations will be discharged later in the future. However, you record the provisions or obligations the moment they arise. The loan may be repaid in the future, credit purchase creditors may be paid in the future. However, the obligation is recorded as and when it arises. So over here, this is obligating events. It is an event that creates an obligation which results in an enterprise having no realistic alternative but to settle or pay. Remember, the obligation can arise due to certain legal obligations which can arise, let us say, due to a law or a contract. Like simplistically, if you have to pay gratuity is paid as per the Payment of Gratuity Act, and hence it may be a legal obligation arising out of a law, or a contractual obligation like a salary, for example, is payable under the agreed contract which is enforceable by law, and hence these are obligations which are existing. Now, when we look at liabilities like loans, like creditors, there's no uncertainty in their measurement. If there's a 10 lakh rupee loan, I know I have to pay 10 lakh rupees. Or if there's a credit purchase which has an invoice value of 10,000, I know I have to pay 10,000, in which case I'll record a liability. However, if there's a present obligation where there is some uncertainty involved in the measurement, for example, I don't know how much will be the repair cost. I have sold goods, I have given them a warranty. So the obligation to repair exists, it is present. But when will the customer come? How much will I spend on repair? I'm not very sure, in which case I will have to create a provision. Provision means a liability that you are creating which has a certain degree of uncertainty. So when does a provision get created? If there's a present obligation, where there is uncertainty in the amount or the timing, you can create a provision. Or there may be certain cases where there are contingencies. Now, contingencies can be contingent liabilities or there can be contingent asset. Now, a contingent liability refers to what we call as a possible obligation, not the present obligation. There's a possible obligation, like you are manufacturing certain goods and selling them. However, let's say your competitor comes and sues you. They say that you have copied their design and hence you have infringed their trademark or a patent, as a case may be. Now, you genuinely believe that you have not copied. However, the designs do look similar, and as a result, the case goes to court. Now, as of now, do I have to pay the penalty? I don't know. In the past, I have sold goods. If the court concludes that that is a breach of the patent, in which case I'll have to pay penalty. But if the court concludes that I have not breached any patent, then I don't have to pay penalty. So over here, when we are looking at a provision or we are looking at this item, there is an obligation, but that obligation is a possible obligation, not a present obligation, which may arise if, let's say, a court decides against us. So this is a factor beyond our control. So if I have to pay for such obligations, this is called as a contingent liability. If I'm going to receive money on account of such obligations, this is called as a contingent assets. A contingent liability is a possible obligation which is again arising out of past events. Remember, it has to arise out of past events, like you have breached possibly a patent in the past, or you have done some pollution in the past for which they are suing you to make a payment. An obligation arising out of past events, the outcome of which will be dependent on, let us say, a court verdict which is beyond our control, okay, which can be confirmed by future events which are beyond the control of the entity. If there's a contingent asset, on the other hand, this represents possible resources that arise due to past events. Possible resources, like if you put a lawsuit on someone, that is a contingent asset. Further, the outcome over here also depends on future events that are beyond the control of the entity, like an insurance claim or, let us say, a contingent asset, for example. Now, when we are looking at contingencies, what will we do in case of contingencies? Well, contingencies refer to either contingent liabilities or contingent assets. When we look at contingent liabilities, these are possible obligations for which you might have to make a payment. Now, is it sure that you have to make a payment? No. Like when you take a loan, you have no choice but to make the payment, and as a result, you show the loan as a liability. However, when we look at a contingency, we are not very sure whether the payment will arise or not. And as a result, what should you do? Well, if nothing is given, we will say that there's a 50-50 chance that you might make the payment or you may not make the payment, and hence you will ideally give a disclosure. Well, will you give a disclosure in the notes to accounts as a part of your financial statements? So if the payment is uncertain, you will give a disclosure. However, if the payment is probable, that is, someone is suing you, your legal experts tell you there is a more than 50% chance that you will lose a case and you will have to make the payment. And if you are likely to make the payment, that is probable, more than 50% chance that a payment will have to be made, then you will create a provision. So this is due to the prudence and conservatism principles, where they say that if there's a more than 50% chance that a payment is likely, then might as well you create a provision. When you create a provision, you will create the provision, and typically the lawsuit expense, compensation expense will be debited to the P&L account. So over here, when you're looking at contingencies, this can be a contingent liability. Contingent liability, if it is probable, how do you define probable? More likely than not. That's a more than 50% chance, then you create a provision, that is expense account debit to provision. However, if it is uncertain, that is anywhere between a 5 to a 50% chance, then you will just give a disclosure in the notes to accounts. Now below 5% chance, or if you believe that the payment is remote. When will it be remote? Well, let us say you are a deodorant company and you have been displaying ads where if you spray deodorants, well, let us say people of the other gender get attracted. Now, someone sprays the entire bottle of deodorant, no one gets attracted, they sue the company. Now, a company has defended such cases in the past multiple times, and the courts have always concluded that these ads are for representational purposes and by no means do they commit to do what they show in the ads. And as a result, over here, we believe that someone is suing us during the year. However, we are pretty sure that we are going to win this case, and hence the payment is remote. It's not even uncertain, it is remote, it is highly unlikely. In which case, you will not even give a disclosure. You don't even want to burden the readers with unnecessary information, and hence you will ignore. Now, the problem is, as a student, how will I know whether the payment is uncertain, it is probable, or is it remote? First of all, if the question clearly tells you that there is a more than 50% chance of payment, you don't just run behind 50%. Sometimes they might say that someone is suing you and your legal expert said that it is probable that you will win. more than 50% chance of winning. But if there's more than 50% chance of winning, that means there's a less than 50% chance of losing, in which case you don't need to make any payment. Remember, payment will be made if there's a more than 50% chance of you losing the case, in which case payment will come. If you win the case, you don't have to make the payment. And as a result, over here, if there's a more than 50% chance of the payment happening, then you will create a provision, but that has to be specifically told in the question. Acha, if nothing of this sort is given, then the question remains silent. Then we will say there is a 50-50 chance. Like if someone asks you, what is the chance of you getting heads or tails? It is not more than 50, not less than 50. It is equal to 50. And at exact 50, there is uncertainty, and hence you will give a disclosure. But you don't know whether it is remote or not. So you will generally make a standard statement that for these cases, you will give a disclosure in the notes unless it is remote. So we will just mention that unless it is remote, you will give a disclosure in the notes. Now this is regarding contingent liabilities. Will the same guidance apply for contingent assets? The answer is no. You will take a step back for contingent assets. That is, if the amount to be received, and when is there a contingent asset? Maybe there is a case that you have put on someone, that is a contingent asset, or maybe there is, let us say, an insurance claim, like there's a loss by fire. Remember, that is your loss only, you will record that loss. But at the same time, if that is covered by an insurance contract, then you will have to make a application to the insurance company. They will send a surveyor, they will do their survey, ask for bills, documents, etc., and then they will communicate their approval. So at that time, the insurance claim becomes receivable. Till that time, it is contingent. Remember, insurance contracts are indemnification contracts. They are different from reimbursement contracts. If a contract is for pure reimbursement, in which case, like for example, when you will do articleship, your CA firms will incur traveling expenses. Now, as a part of your audit arrangement, those client traveling expenses are to be paid by the client. But the client says every time you take a rickshaw or an auto or an Uber, every time you call them to make the payment, rather they say you make the payment and then we'll reimburse it to you. Now the reimbursement is virtually certain. These are client's expenses which you are paying for convenience, and as a result over here, what will you say? Let us say if your traveling expenses, for example, are 100, client has agreed to a reimbursement, for example, to the extent of 60%, which means, and it is virtually certain that they will reimburse, in which case we will say that ideally, if you have not yet paid this, your entry would be, let's say, traveling expense account debit. You have an agent through whom you have booked the ticket. So this is traveling expense account debit, 100. No sir, not 100. Only your share, that is 40. Reimbursement asset, that is money that is going to be received from the client. Reimbursement asset, account debit, let us say 60. To bank if the payment is made for 100, or to a payable if a payment is not yet made, let us say for 100. Can I net off and show the net payable only at 40? No. I will separately show the reimbursement asset at 60 and I will separately show a payable at 100, because even if I don't get a reimbursement, I am supposed to pay the entire 100 rupees, and hence I will have to show in my balance sheet the payable if the money is not paid and the reimbursement receivable separately. But in my P&L, I will only show my net expense, which is, let us say, 40. An insurance contract, one needs to remember, is an indemnification contract. It is not a reimbursement contract. When the loss by fire happens, that does not immediately mean that the insurance company is going to give the proceeds. They will do their survey, you will have to make an application, and only then will the money become receivable. Till that time, it is contingent. Now for contingent asset, you will take a step backwards. That is, you will say that if the money is probable, that is, there is a more than 50% chance that you will receive the money, you will still give a disclosure. No sir, we generally record it. Yes, you record it if it is a liability. However, here we are talking about assets, and for assets, prudence and conservatism says that you will record income as and when you earn it. You will record expenses as and when, let us say, you expect it. And as a result, even if you expect that there is a more than 50% chance of payment in contingent liabilities, you will create a provision. But in contingent assets, you will just give a disclosure. Similarly, if there is uncertainty in contingent liabilities, you will give a disclosure. If there's uncertainty, in case of contingent assets, you will ignore it altogether. So when you look at a case where it is probable, you will disclose it. That too in the director's report, not in the notes to accounts. If it is uncertain, that is less than or equal to 50% chance, you will ignore it. However, when will we record it in our books? We will record it when there is virtual certainty. Now, this is the strongest form of certainty. Virtual certainty is not more than 50% chance, not more than 75% or 80% chance. This is certainty which is beyond any kind of doubt. Like, for example, you will study various terminology like probable, more than 50%. When you do AS19, major part of economic life, more than 75%. Substantially covers, more than 90%. Virtual certainty surpasses all of them. It says, we are not looking at probabilities. We are looking at actual facts. Like when you go to a lawyer and say, I want to sue the other party for a particular claim, the lawyer says, if you have given me the case, forget it. Consider it done. People have confidence like this. In which case, can you say it is virtually certain? No. It is probable, maybe highly probable, maybe substantially, but not virtually certain. Virtual certainty arises when the judge puts in his hammer and says that you have won the case and this is a compensation that you are going to get. That is when virtual certainty arises. And virtual certainty comes from facts, not from estimates. You go to an insurance agent and you say, I want to file for insurance. Agent says you will get the money. Don't worry. That is not virtual certainty. Insurance company, when it communicates that your claim has been approved and processed, and this is the amount that you are going to receive, that is called as virtual certainty. Virtual certainty, remember, goes beyond estimates and opinions. It arises from facts, and only then can you record. When you record the asset, that is a receivable, let's say insurance receivable, compensation receivable, and the second effect will generally be taken to the P&L account. So you will record asset only when there is virtual certainty, but for liabilities, you don't need virtual certainty. You can record it the moment they are probable, at least for contingent liabilities. Now, sometimes what might happen is, in case of contingent liabilities, you might be told that you will quite certainly win the case. Okay, which means you don't have to pay anything. So there will be no provision. At max, you can give a disclosure. However, you still have to pay the legal fees, the lawyer's expenses, for which no one is going to reimburse you. In which case, you will have to recognize the legal expenses or the legal fees, as the case may be, in case no one is going to give you a reimbursement. But if there is going to be a reimbursement, then only the amount that is not going to be reimbursed will be shown as your expense. Apart from that, the payable will be shown separately as a liability and a receivable will be shown separately as an asset. Okay, so over here, when you look at probable is defined as more likely than not, that is more than a 50% chance. Exactly 50 is not probable. Virtual certainty is arising from facts and is not linked to any opinion or estimation. Formal communication will result in virtual certainty. And reimbursement assets. Institute likes asking you questions. Reimbursement in various forms. It can be, let us say, you have an obligation to repair, let's say warranty obligation, but someone has agreed, let's say the manufacturer has agreed that he will reimburse this cost to you, in which case I will show a separate provision, a payable for the warranty, and at the same time I will show a separate receivable, a reimbursement if it is virtually certain that the reimbursement is going to happen. In case expense has been agreed to be reimbursed, then entity will only record net of reimbursement amount as expenditure. In our example, we recorded only 40 and the amount agreed to be reimbursed, entity will record a receivable for the reimbursement. Okay, as a general principle, assets and liabilities need to be recorded separately. That is, I cannot net off the receivable 60 with the payable of 100. I'll have to show them separately. That is, they cannot be offsetted unless a transaction is expected to settle net. What do you mean by transaction expected to settle net? Which means when you will study tax, there will be a provision for tax and there will be advance tax. Let's say you have earned a profit of 100 crores on which 30%, that is 30 crores, is the tax that you have to pay. However, you have already paid an advance tax of 25 crores which is appearing as an asset in your balance sheet. So in your balance sheet, you might see a provision for tax as liability and advance tax as an asset. However, what do you have to do? Sir, if I have to pay 30, out of which 25 is already paid in advance, that means I have to pay only the net 5, and hence you can net these amounts off because you need to pay only net 5. However, in our example, for this traveling, I need to pay 100 to the agent whether I get the reimbursement or not. And hence a payable will be shown separately, and separately a reimbursement asset will also be shown. Okay. For example, provision for tax and advance tax can be net settled, and only the net self-assessment tax needs to be paid. Hence, in the balance sheet, provision for tax and advance tax are permitted to be netted off. However, housing loan and the house acquired have to be shown separately. You can't just show the house net of the loan amount. The reimbursement receivable, that is an asset, should be shown as a separate asset and cannot be netted off against a liability or a provision, since each of these items will be separately settled. So basically, when will you create a provision? If there is a present obligation, like warranty, remember, is a present obligation. It arises the moment the sale happens. If there's a present obligation which cannot be measured very reliably, that is when you create a provision. Or if there's a possible obligation, like a contingent liability, an ongoing lawsuit, for which it is probable, that is a more than 50% chance that you will make a payment, that is when a provision is to be created. Further, one needs to be very clear on whether the obligation is present or possible. Like when you look at a warranty, the obligation is present. However, how much expense will be incurred of repair, that is a little uncertain, but the obligation to repair exists the moment you make the sale, and hence that is a liability which will result in a present obligation. There is another thing that you will study in AS 10. This is provision for site restoration, which is covered under AS 29 as well. What does the provision for site restoration say? That if I were to, let us say, construct an oil well or a nuclear plant or dig up a mine, the government will say that, okay, you will be under an obligation to restore the site in the location and condition it was when you took it. So that is a site restoration obligation. Now, when does the obligation arise? The obligation usually arises the moment you construct the asset. The moment you construct the asset, you are under an obligation to dismantle it. Sir, but we will dismantle it at the end of the life. Yes. You will discharge it later. Like the moment you take the loan, you are under an obligation to repay. You don't want to repay immediately. You repay at the end. However, you have to create a liability for the loan. In a similar way, the obligation to dismantle arises the moment you construct the factory. The moment you construct the factory, even if you decide on the very next day to walk away, you will have to dismantle. So the obligation to dismantle exists, and hence you will create a provision, and this is one of the very few cases where the provision is created on a present value basis. In all other cases, present valuation is not done, but usually because site restoration happens deep into the future, Institute allows you to record it at a present value basis. But again, you'll have to track. We'll do sums on this, on what is the obligating event for this provision. Sometimes the obligating event is the construction of the oil well, in which case you will create a provision at the time the oil well is constructed. But sometimes the obligating event may also be extraction of oil. So when you construct the oil well, there is no obligation to dismantle or restore, but the moment you start extracting the oil, the nearby surface will get very dirty. So there will be an obligation to clean up, but that obligation arises the moment you start extracting oil. So the obligating event over here is similar to extraction of oil. We'll do sums on this. So over here, decommissioning and site restoration obligation, it is estimated that the expenditure which may be need to be mandatorily incurred at the end of the life in order to bring the project site back to its original condition, like filling up of the mine site after extraction activity is completed. In case the company has agreed to restore the site back to the original condition, then the obligating event has happened as soon as the asset is ready, constructed. In such a case, a provision for site restoration should be recorded as soon as we have constructed the original asset as per AS 10. This provision is permitted to be recognized on a present value basis as per AS 29. Now, sometimes students get confused with provision for site restoration with other provisions. Like when you were to buy a ship or when you were to buy an aircraft, let us say the law might say that every 5 years you will have to repair and overhaul the ship. So someone says, okay, after 5 years you have to repair and overhaul, which means you will create a provision. See, the obligating event is what? The obligating event arises after 5 years. Right now you are under no obligation to repair. Someone says, nahi yaar, that to site restoration also you have to do after 5 years only. Okay, however, if you decide after 1 day or 5 days that you don't want to continue, will you still have to dismantle? Yes. But if after 5 days you decide you don't want to operate the ship or aircraft, will you have to repair or overhaul? No. So the obligation arises in that repair or overhaul example after 5 years. Or if you have to replace, let's say, a part, that obligation arises after 5 years. But when you do a site restoration, the obligation to dismantle arises the moment you construct it. Remember, this is a little confusing and taxing, but the obligation exists the moment you construct it. Even if the next day you decide that I don't want to use it, you will have to dismantle it. Similarly, warranty obligation arises the moment you sell the goods. Even if you later thought that 2-3 years the goods will not develop defect, if they develop defect on the very next day, you will have to repair those goods. But in case of an overhaul, in case of a repair, or in case of a replacement which has to be done after every 5 years, if you decide not to use the asset after 1, 2, 3 years, you are under no obligation to repair. or overall, and as a result obligations in such a case will arise, let us say after 5 years. This is also some sums that you will do. These are various cases that we are trying to discuss over here. Now let us say you come to a point where you say कि चलो ठीक है, I can figure out that when do I have to create provision, when do I have to give a disclosure, but you have to create a provision or disclosure at a particular amount. Now the problem is, because these amounts are uncertain, there's no one fixed value, and as a result, how do you measure these amounts? Well, for the measurement, there are two methods. One is called as the expected value method and one is called as the most likely value method. What do you mean by expected value method? Let us say there is an ongoing lawsuit, and under the ongoing lawsuit, you have various probabilities. Let's say probability of winning, then probability of losing where you will pay low damages, or probability of losing where you will end up paying a high damage. Okay, the probability of winning is only 30%. The probability of you paying low damages is 50%, and the probability of you paying high damages is 70%. If you win, you pay 0. If you lose with low damages, you pay 100. If you lose with high damages, you pay 500. In such a case, what do you think? First question you'll have to answer is, well, it is an ongoing lawsuit. So is there a present obligation or is there a possible obligation? Sir, it is possible. I might have to pay. But is this possible obligation probable? That is there more than 50% chance of payment? Well, yes, there seems to be a 70% chance of a payment happening. There seems to be a 70% chance of a possible payment happening, and as a result, what do you guys think? Well, we will have to create a provision, but the problem is provision is to be created at what value? Well, we will say that provision has to be created if it was to be created using the expected value method. In the expected value method, provision is to be created at the probability based weighted average, that is 30% chance to pay 0, 50% chance to pay 100, and 20% chance to pay 500. If I do a probability based working, I will end up getting, for example, 150. But what do I have to do with this 150, sir? I will have to give a provision. So for 150, I will have to give a provision. Are we clear with this? Okay. So on the other hand, let us say, now this is very much possible. On the other hand, there is another possibility of, for example, if I take a separate example, the probability of winning is 70%, probability of losing with low damages is 20%, and probability of losing with high damages is 10%, in which case, again, I can find the expected value. Okay, but it is a possible obligation where payment is uncertain. It's not probable, not more than 50% chance. Over here, there seems to be a 30% chance that the payment will have to be made. So over here, this is 0 into 70% plus 100 into 20% plus 500 into 10%. So over here, this will come to what? 20 and 50, that is around 70. But this 70, I will just give a disclosure in the notes. This is using the expected value method. So what is expected value method? Provisions should be recorded on a best estimate basis, but how do you find the best estimate? Over here, in case there is a range of possible outcomes, we can take the probability based weighted average in order to find the provisions. So there is a range of outcomes. There are around 3 possibilities over here. However, another method is a most likely value method. Like for example, there is a 90% chance that you will have to make the payment. There's a 10% chance where there will be no payment if you win the case. So 90% chance you'll have to pay 100, 10% chance you'll have to pay 0. If you were to find expected value method, you will take the probability based weighted average, that is 90% of 100 plus 10% of 0, that is 90. However, it is most likely 90% chance. There are 2 outcomes and one of them is highly likely. That is when practically people use most likely method. We said it's highly likely that you'd have to pay. But when you have to pay, you don't have to pay 90, you have to pay 100. Remember, 90 is like an average. An average is a slightly flawed concept. Like if you have 100 people in a class, 50 of which are 5 feet height, 50 of which are 6 feet height, the average height comes to 5.5 feet. If you were to pick any random person from class, that person will either have a 5 feet height or a 6 feet height, but average height is 5.5 feet. No one in the class is 5.5 feet. In a similar way, 90 का payment तो आएगा ही नहीं. If a payment comes, it will be 100 or there will be 0. So the most likely amount over here is what? 100. Practically, when do you do most likely method? When there are only 2 possibilities and one of them is highly likely, then you usually take the most likely value. But again, It is on the management which method they want to use. If there are only two possibilities, entity may use the most likely method in order to measure the provision, as we are likely to value it directly without multiplying the probabilities. Remember, when you measure the provision, you will do this on a pre-tax basis and on an undiscounted basis. That is, you will not do net of tax. Tax impact, if any, will be shown separately in the provision for tax. So, you'll do the measurement on a pre-tax and an undiscounted basis. That is, you will not do the present valuation unless it is a provision for site restoration, in which case present valuation is permitted. So, the exception is site restoration, decommissioning or dismantling. Acha, what do you guys think? Provision once determined, can you keep on reassessing it? Yes. It is not that provision once determined cannot change. You will have to keep on reassessing it to ensure that it comes to the most reliable value. Perfect. So this kind of takes care of theory by and large. There's also another provision which is a special case, which is a provision for restructuring, or restructuring is like reorganization. Or if you have 3 or 4 divisions, you are planning to close one of them, that's like a reorganization. Or if there's a change in management, then that is a reorganization. Now, this will cost the company a little, and hence there may be some legal fees, legal costs, etc. These are called as closure costs, costs which are linked to closure. And you will create a provision for reorganization or restructuring the moment you are under an obligation to reorganize or restructure. Like, for example, ByteDance is a parent company of TikTok. Now, TikTok was, suppose ByteDance is a big company, one of the divisions is TikTok. Let's say the Indian government says that TikTok cannot operate in India anymore, and you are given a 6 months time to wind up the TikTok segment. Now, for you will have to close, and you are under an obligation. The court order, the government order is an obligation to close. Now, that arises the moment the court order is there, in which case you will have to estimate that what will be the possible closure cost, and you can create a provision for the closure cost. This is called as a restructuring or reorganization provision. Remember, you will only take the cost linked to closure, not cost linked to continuance, like retraining, relocating employees. No, that is linked to continuance and not linked to closure. You will do that probably at final CA, but at CA Inter, just having a broad understanding of provision for restructuring should kind of be sufficient. So that takes care of AS29 on the concept front. Now, on your sums front, there are close to 19-20 problems, and the LDR problems we have mentioned. A lot of these problems have different variety. It is not as basic as maybe an AS1 or an AS4 or AS5. So it's important that you practice these questions to get a fairly better understanding. Okay, so let us go to these questions. Question number 1, it's an important question, I would say. We have marked the last day revision question separately, but we'll do all of the problems in any case. So let us go to question number 1. At the end of the financial year ended 31st March 17, a company finds that there are 20 lawsuits outstanding. So these are possible obligations because the lawsuits are outstanding, which have not yet been settled till the date of approval of accounts by the board of directors. The possible outcome estimated by the board is as follows. In respect of the 5 cases, first 5 cases, the win probability is 100%, and hence there is going to be a 0% loss, in which case you don't need to create any provision. You don't even need to give a disclosure because there's a 100% possibility of you winning. So payment is remote. Next 10 cases, the win probability is 60%, in which case you will pay 0, but the loss with low damages 30%, loss with high damages is 10%. So basically the probability of losing is 40%. Still, overall probability is of winning. There's a 40% probability of losing. So the payment is not probable. So what will I have to do? Sir, I have to give a disclosure. But the problem is disclosure will be at what amount? So 0 into 0.6 plus 1,20,000 into 0.3 plus 2 lakhs into 0.1. So this comes to 1,20,000 into 0.3 and 2 lakhs into 0.1. So this comes to, I think, 56,000 unless given otherwise. This is per case. Institute takes it, and hence for 10 cases, this is 56,000 into 10, that is 5,60,000. Similarly, for the remaining 5 cases, out of 20 cases, 5 you are expected to win, so nothing. Next 10, there's a 60% chance of winning, 40% chance of losing, and hence you will give a disclosure. And then for the last 5 cases, the remaining 5 cases, the win probability is 50%, and loss with low or high damages probability is also 50. Now we are exactly 50-50. You guys tell me. Exactly 50-50 पे हम क्या करते हैं? Sir, we give a disclosure. And as a result, if I were to give a disclosure over here, I will say 0 into 0.5 plus 1 lakh into 0.3 plus 2 lakh 10 into 0.2. If I do this, this is 1 lakh into 0.3 and 2 lakh 10 into 0.2. Total comes to around 72,000. Again, this is 72,000 per case, and there are 5 such cases. So your total disclosure in the notes, unless given otherwise, you will follow the expected value method, will be 56,000 into 10 plus 72,000 into 5. So this comes to around 5 lakh 60 plus I think 3 lakh 60, and hence a 9 lakh 20,000 disclosure will be given in the notes. A very similar question is question number 16. If you want, you can try the same. So this is question number 1, where we have been told that there is a 9 lakh 20,000 expected loss to be disclosed in the notes because it is a contingent liability. Next, we have question number 2. It's more like an AS4 type and AS29 combined question. Exox is in the process of finalizing its accounts for the year ended 31st March 17. So it is in the post-balance sheet period. The company seeks your advice in the following. The company's sales tax assessment for the year 14-15 has been completed on 14 February 17. This is completed during the year, and hence you will record this with a demand of 2.76 crores. This is an actual liability. The company paid the entire demand under protest without prejudice to the right of appeal. The company files its appeal before the appellate authority, wherein grounds of appeal cover tax on additions made in the assessment for the sum of 2.1 crores. So I'm fighting for 2.1 out of 2.76, which means I've accepted 0.66. So for 0.66, I'll record an expense with the corresponding provision if required, or a payment. And for the remaining 2.1, the outcome is contingent dependent on the outcome of the appeal. So if you believe that you will win the appeal, then you can give a disclosure. If you believe that you will lose the appeal and payment will be made, then you can create a provision or an expense. Now if nothing is given, we will assume there is a 50% chance, and hence you will give a disclosure for 2.1 crores, whereas create an expense for 0.66 crores. Point 2, company has entered into a wage agreement in May 17, whereby the labor union has accepted a revision in wages from June 16. The agreement provides that the hike till May 17 will not be paid to the employees but will be settled to them at the time of their retirement. The company agrees to deposit the arrears in government bonds by September 17. So what they are saying is there is a wage agreement which is entered in May 17, that is during the post-balance sheet period, but we are in the process of finalizing the accounts. This wage agreement pertains to you fixing the wages for the year, and hence at least wages for the year June 16 to March 17, whatever these wages, will be recorded in the year 16-17, assuming that the condition existed on the balance sheet date because you have rendered the service, and hence this helps you in determining the amount that you had to pay for the employee service as on the balance sheet date. An alternative interpretation is possible here, but that is what we are currently going to take. And then for the next 2 months, we will not record anything. So for the month of April 17 to May 17, this will be recorded in the year 17-18 itself. Okay. So this is point 2. Now question 3 is a little confusing. We'll probably do that slightly later after we do a few other questions. You'll go to question number 4. Now an airline is required by law, तो law देख के अपन कुछ और ही सोचते, to overhaul its aircraft once in every 5 years. Let us say the question ends over. So when do you think the obligation to overhaul arises? Sir, the obligation arises after 5 years are passed, or the obligation arises the moment you purchase? Sir, it is after 5 years. No, sir, it is required by law that we have to overhaul every 5 years. So the obligation arises the moment you purchase. No. Remember, even if you purchase the aircraft and then decide not to use the aircraft, after 1 or 2 years, you are under no obligation to repair. But if it was a dismantling obligation, even if you decide not to use, after 2 years, you will still have to dismantle. So the timing of obligation is important in this case. It arises after 5 years. The Pacific Airlines, which operates aircrafts, does not provide provision required by law in its final accounts. Yes, that is correct. You don't need to create a provision up to 5 years. Discussed with reference to AS29. So over here we can say provision is not required till 5 years. So over here, no provision is needed in the first 5 years. If the entity continues to use beyond 5 years, then it will have to create a provision at that time. So this is question number 4. Now this is question number 5, which is also an important question, I would say. An engineering goods company provides after sales warranty for 2 years to its customers. Now, based on past experience, the company has been following policy for making provision for warranties on the invoice amount on the remaining balance warranty period. Okay, so for less than 1 year, 2% provision, more than 1 year, 3% provision. So it depends on how much time the warranty is still pending as on the balance sheet date. The company has raised invoices as under. So on 1st January 11, so if it's a 2-year warranty, this warranty will expire on 19th Jan, let us say 2013. If it's a 2-year warranty, this will expire on 29th Jan 2014. If it's a 2-year warranty, 15th October 2014, this is when the warranty will expire. Calculate the provision to be made for warranty under Accounting Standard 29 as on 31st March 12 as well as 31st March 13, and also compute the amount to be debited to the P&L for the year ended 31st March 13. So when I look at, let us say, a provision to be created for as on 31st March 2012, over here for the first invoice, I will say that the time still remaining is close to 9 months and around 19 days, and hence the time remaining is less than 1 year. And hence provision that will be created will be, let us say, at the rate of 2%. For the second invoice, 29 January 14, so from 31st December 12, that is around 1 year, 9 months and 29 days, and hence this is for more than 1 year, and hence the provision is 3%. For the third, if I just compare the warranty, it will show 2 years and 6.5 months, but that is fundamentally wrong, because this sale is happened on 15th October. Remember, the provision for warranty arises the moment you sell the goods. As of now, on 31st March 12, the goods have not even been sold, and hence there will be no provision. So over here, 2% of 40,000 will come to probably, I think, 40,000 into 2%, 800, and 25,000 into 3%, 750, and hence your total will be 1550. Okay, next you go to 31st March 2013. Now over here, if you go to see, this warranty would have expired by 31st March 13 for the first invoice, and hence there will be no provision. For the second, from 31st March 13, you just have 9 months and 29 days remaining, and hence less than 1 year. So this is a provision to be created 2% of 25,000, and hence this is 500. And lastly, 15th October 2014, so that is around 1 year, 6 months and 15 days, and hence this is more than 1 year. So this is 3%. 3% of 90,000 comes to 2,700, and if I were to total this, this comes to 3,200. Now I have not been given details regarding actual expenses, and hence if I have to figure out how much will be debited to the P&L for the year, we will say if the opening provision was 1550, closing provision comes to 3,200. That means the difference between the two, 3,200 minus 1550, comes to around 1650, which will be debited to the P&L. So this is question number 5. It's a reasonably good question, I would say. 1550, 3,200 and 1650. When I go to question number 6, WXW is in dispute involving an alleged infringement of patents by a competitor company who is seeking damages for a huge sum of rupees 1,000 lakhs. The directors are of the opinion that the claim can be successfully resisted by the company. How would you deal with the same in the annual accounts of the company? Now, over here, someone is suing us. However, the directors are of the opinion that we can successfully resist, that is, win this claim, and hence, you don't need to create a provision because the amount is not payable. So over here, you will give a disclosure in the notes unless we can say that this is remote. Now, the question can also go further and say that, however, you will have to spend 2 lakh rupees to defend this case, in which case you will have to create a provision for 2 lakhs if you believe that that 2 lakhs is not reimbursable. This is question number 6. Now we go to question number 7. Now this is interesting. X has not made a provision for warranty in respect of certain goods due to the fact that the company can claim warranty cost from the original supplier. Let us say you are an authorized showroom and some people come to repair cars from you. So you have, while selling, you have said that you will repair this free of cost. But behind the doors, we have agreed with the supplier original supplier of the cars that they will reimburse this cost. Now the thing is, when a customer comes within the eligible period to get his car repaired, I will have to repair it free of cost. This is irrespective of the fact that the manufacturer will give me reimbursement or not reimbursement, and hence I will have to create a provision for warranty. The reimbursement right, if any, is a separate right which will be recorded as a separate asset separately. Hence, the accountant of the company says that the company does not have any liability for warranty on a particular date. Well, it has a liability, but then there is a separate reimbursement asset as well. There are two separate transactions. As the amount gets reimbursed, you are required to comment on the treatment done by XYZ in line with the provisions of AS 29. Well, this is not correct. You will have to show provision separately, and if the reimbursement is virtually certain, then a reimbursement asset or a receivable, these have to be shown separately in my balance sheet. Are we clear with this? Yes. So amount to be, company needs to record provision as a liability and separate reimbursement, right? For the reimbursement from the original supplier, this has to be shown separately in my balance sheet. In my P&L, yes. If I'm going to receive the reimbursement, that is virtually certain, I can always say that my net expense is nil, like that traveling expense case. But the question is, let us say, looking about the balance sheet presentation. Achha, question number 8 is a very interesting question. This has site restoration as well as financial guarantee. So with the reference to AS 29, how you deal with the following in the annual accounts of the company as on the balance sheet date? An organization operates an offshore. Offshore is, let's say in the sea, oil field, where its licensing agreement requires it to remove the oil rig at the end of the production and restore the seabed. Remove the oil field and restore the seabed. 90% of the eventual cost are related to removal of the oil rig and restoration of damage caused by building it, and 10% arises due to extraction of oil. At the balance sheet date, the rig has been constructed but no oil has been extracted. So, is there an obligation for site restoration? Yes. But the provision for the same, if it has to be created, it has to be created for 90%, maybe present value, but 90% of the estimated amount. Why? Because if there's 100 rupees which are expected to be incurred, 90 of that is linked to the construction, and construction has already happened. So you are under an obligation to restore, maybe later, but you are under an obligation. The remaining 10% is linked to extraction of oil, but the extraction of oil has not yet happened, and hence for that 10%, you will not create a provision as of now. You will create once the extraction of oil starts. Are we clear with this? So over here, for 10%, you will create the provision. For the remaining 90%, you will not create a provision. Again, you will have to create it on a present value basis in this particular case. Now, the second case would be linked to financial guarantee. Like in Contract Act, you must have studied that in guarantee there are three parties. Let's say there's SBI who's giving the loan. Let's say there's X Limited who's taking the loan. Now in SBI's books, that loan given is an asset. You have a contractual right to receive. In X Limited's books, you have an obligation to pay, and hence that is a liability. But the problem is there might be a surety. There's a person who is giving a guarantee to SBI that if X does not pay, then that surety, that is Y, will pay. Now in the books of Y, the liability to pay SBI is contingent on the fact that if the principal debtor, that is X, defaults, then I will have to pay. So my liability is contingent. So at every balance sheet date, I will have to think that whether it is probable that there is a more than 50% chance I'll have to make a payment, in which case I'll create a provision or a payable. However, if there's less than 50% chance or equal to 50% chance, there is uncertain, in which case I will just merely give a disclosure. So during 1819, ACE gives a guarantee of certain borrowings of Brew whose financial condition at that time is sound, which means it is not probable that I'll have to make the payment, and hence I'll just give a disclosure. Now during 1920, the financial condition of Brew deteriorates, and as on 31st December 2019, it goes into liquidation. Balance sheet date is 31st March 19. So basically, if I look at the year 1819, that is a balance sheet date of 31st March 19, as on this date, can I say that the condition is sound, in which case I will just give a disclosure? On the other hand, if it was asked for the year 1920, that is the balance sheet date on 31st March 2020, now they have gone into liquidation and hence I'll have to make a payment, in which case now can I say I will have to create a provision? Yes, the question is not asking you for the second year, but in case it was asked, this is a extra case. So over here, in the first case, we are saying at balance sheet date, extraction has not, we'll create a provision for 90% of the estimated restoration cost. The remaining 10% will be created as and when oil extraction starts. And here, during the year 1920, financial condition deteriorates and provision or liability needs to be created in 1920. But during the year 1819, we just need to give a disclosure. Okay. Then you have question number 9. This is similar to 7 and hence that warranty wala case. Company has not made any provision for warranty for certain goods considering that the company can claim warranty cost from the original supplier. You are required to answer, well, this is same. We will say that we will have to show a provision separately and a separate reimbursement asset to be shown separately. Now this is question number 9. Now on similar lines, there's a question number 3 which we said we will do later. Now we will review this. Over here what was happening is there would be a sale that you were doing to my customers, and to my customers I was charging money on a cost plus profit margin basis. So if I have incurred 100 rupees of cost, 100 plus 10%, 110 I would bill. Now what happens is you are a public sector undertaking and the government, let us say, has required you to pay your employees instead of 100 rupees 150 rupees. That is, there is an increase of 50 rupees on the cost, in which case you will have to show a provision for that 50 rupees. But at the same time, do I get a separate reimbursement? Well, yes, I do get a separate reimbursement. I mean, assuming it is virtually certain that the reimbursement would be received, then a separate reimbursement asset would be recorded. Over here, this is what they try to review. This is, I would say, question number 7 or 9. Like that warranty question is a little more clear. This is a little more complicated. So you first review question number 7 and then come back to this. Now Shyam, a public sector company, provides consultancy and engineering services to its clients. In the year 10-11, the government set up a commission to decide about the pay revision. Okay, the pay will be revised with respect from 1st January 2006 based on the recommendations of the commission. Now that is a retrospective revision. The company makes a provision for 680 lakhs for the pay revision in the financial year 10-11. Should I create a provision? Yes. On an estimated basis, as a report of the commission is yet to come. But I believe that I'll have to make that payment to the employees as per the commission, and hence I record it. As per the contracts with the client on a cost plus job, the billing is done on actual payment made to the employees and allocated to jobs on hours booked by the employees on each job. The company discloses this through the notes. That is, salaries and benefits include provision of 680 lakhs in respect of pay revision. The amount chargeable from reimbursable jobs will be billed as per the contract when the actual payment is made. Fair enough. However, when the actual payment is made, you will bill and you will recover money. So this is a reimbursable asset based on the contract. Reimbursement can be claimed. So the accountant feels that the company should also book or recognize the income by recording 680 lakhs in the P&L as per the terms of the contract. Now you can't book it as an income per se, but 680 of cost and 680 of income in the P&L net off. Otherwise, it will be a violation of the matching concept and understatement of profit. Comment on the opinion of the accountant in relevance to the relevant accounting standards. When I look at the P&L, on my P&L, I will say there is no real expense. Because मेरा cost तो है ही नहीं ना, it's like traveling expense. It is the client going to pay. In a similar way, over here, in a cost plus job, it is a client which is going to pay, and hence my net cost will be 0. However, when I look at my balance sheet, in my balance sheet, I'll have to show a separate provision, that is 680, and a separate reimbursable asset. This is what the institute does, and hence it is advisable you also show it accordingly. So over here, we are saying in the income statement, there would be no impact since the entire 680 lakhs would be reimbursed, and hence there is no cost to the entity. Unless specifically given, we'll assume that it is virtually certain that the reimbursement will be collected. Question 3 and 7, and hence we have created a reimbursement receivable. Little debatable this question, but we have just given you the gist of what the institute has done. Next you go to question number 10. It's more like a theory question. Explain whether a provision is required under the following situations as per AS 29. There is a present obligation that probably requires an outflow of resources, and a reliable estimate can be made of the amount of the obligation. Should you create a provision? Yes. This is like a warranty provision where there is a present obligation the moment you make the sale, and you can reliably estimate how much will be the cost. Second, there's a possible obligation like an ongoing lawsuit or a present obligation that may but probably will not require an outflow. May but probably will not. And hence there is uncertainty. In which case will you create a provision? No. What will you do? We will just give a disclosure. It is like a contingent liability that needs to be disclosed. And last, there's a possible obligation or a present obligation where likelihood of an outflow is remote, in which case you will ignore it. That is, neither a provision is required nor is a disclosure required. So over here, in the first case provision, second case disclosure, third case no provision, no disclosure. Next is question number 11. This is RTP November 21. A similar question was also asked in RTP of September 24. Let us review this. A company incorporated as an NPO. NPO is not for profit organization, also called as a Section 8 company, is having its main objective to promote the trade by organizing trade fairs and exhibitions. So you have Confederation of Indian Industries, CII for example, or Indian Merchant Chambers. These have the main objective of promoting trade. While organizing trade fairs and exhibitions, it decided to charge a 5% contingency charge. It will charge it from the participants. For the participants or outside agencies on income received by them, for income received from them by the company. While in case of fairs organized by outside agencies, 5% contingency charges are levied separately in the invoice. Either ways, I am levying a 5% charge. If it is conducted in my premises, then it will be probably a part of my overall cost that I am charging. If someone else is conducting in their premises, I will charge that separately. The contingency charges in respect of fairs organized by the company itself are inbuilt in the space rent charge from the participants. Both are credited to the income and expenditure account of the company. So I am charging 5%. So that is income for me. So it is correctly to be taken in the P&L account. The intention of levying these charges is to meet any unforeseen liability. Okay, like there can be a stampede or a calamity in a fair organized. So during that stampede or let us say a natural calamity, I'll have to incur certain expenses and hence I'm charging 5%. But can I create a provision? No, the obligating event over here, income I can recognize, but against that I can't book a provision saying that wo kharcha to hoga hi. Well, kharcha to tab hoga if there's a stampede or a natural calamity. If there's no stampede or natural calamity, there is no need to create a provision which may arise in the future. Now, the instances of such unforeseen liabilities could be on account of injury or loss of life to the visitors or the exhibitors due to fire, terrorist attack, stampede, natural calamities, and other public and third party liability. The chances of occurrence of these events are high because the large crowds visit the fair. But have these events happened? No. And hence there is no need to create a provision, at least as per Institute Solutions. The decision to levy a 5% charge was based on assessment only, as actual liability cannot be estimated. I don't know whether such a stampede etc. is going to happen. It is like saying that when I'm an insurance company, when I receive the premium, I definitely record the premium as income over time. However, the expense I record when the actual claim happens. I do not recognize the expense other than that, because until the time the claim happens, I don't know whether I have to pay anything or not. Now, the accounting treatment and disclosures made by the company in its financial statements are 5% contingency charges are treated as income, and a match, this is fine, you can show it as income, and a matching provision for the same is also made in the accounts. I don't think that is correct, because there's no obligation. Second, a suitable disclosure to this effect is also made in the notes forming a part of the notes to accounts. You are required to comment on whether the creation of provision for the contingencies in the facts and circumstances are in line with AS 29. The answer is no. No provision needed because there is no obligation. No provision needed because there is no obligation. So, from the above, it is clear that contingencies considered by the company, neither a present obligation exists because of past events, nor is a reliable estimate can be made. Accordingly, a provision cannot be created for such contingencies under the facts of the case. Now, if I look at question number 20, I would say this is exactly same as question number 11 that we just did. The entire para is the same, just that at the end they are asking you whether creation of any provision under the facts and circumstances is in conformity with AS29, we will still say no. Second part says if the answer is no, then what should be the treatment of the provision which is already created in the balance sheet? Well, you will have to reverse it. So provision over here will be debited, in which case your reserve or P&L as a case maybe will be credited. So over here we have said provision is for liability since contingencies stipulated by the company are not known at the balance sheet date. Provision cannot be created. Therefore, provision so created shall be treated as a reserve. That is, you will transfer it to a reserve. Provision account debit to reserve. Okay, so again you can just review them for a better understanding. That is question number 11. Next you go to question number 12. An oil company has been contaminating land for several years. It has been doing this in the past. So there is a past event. It does not clean up because there is no legislation requiring cleanup. So that's fine. No one can make you clean up. On 31st March 21, it is virtually certain that a law requiring cleanup of land already contaminated will be enacted shortly at the year end. Now will you have to clean up? Yes. So what do you guys think? Should you just ignore it? No, we'll have to create a provision because now it is virtually certain. Forget virtually certain. Even if it was probable, you would have created a provision. Is provisioning presently necessary considering the circumstances of AS29? Yes. It is a possible obligation. However, it is probable in this case virtually certain and hence a provision should be created. Oil company has to provide for such cleanup cost in the year when the law is virtually certain to be enacted. If it was enacted, then there is a liability. Now it is still a contingency. However, it is virtually certain. Even if it was probable, you would have still created a provision. Next, you go to question number 13. Subpoint 1 is same as what you did in question 8, subpoint 1 with reference to AS29. How do you deal with the following in the annual accounts of the company at the balance sheet date? The company operates an offshore oil field where licensing agreement requires to remove the rig at the end of production and restore the seabed. 85% of the eventual costs relate to removal of rig and restoration of damage, and 15% arise due to extraction. Now at the balance sheet date, rig has been constructed, but you have not started extracting the oil. And hence what will I do? Well, I will create a provision at 85% of the present value of the expected cost. Same. Subpoint 2 is a new part. The government introduces a number of changes to taxation laws. Like as we speak, the government is planning to introduce a new income tax act. You might have studied or you might be studying Income Tax Act of 1961, but the government is planning to have a new act. Now, if the new act actually comes, people who are already practicing will need to update their understanding and hence they might need training. Okay, the government introduced a number of changes to tax laws. As a result of these changes, the company will need to train a large portion of its accounting and legal workforce in order to ensure continued compliances with tax law regulations. Acha, but is it under an obligation to train? No. Well, can it tell the employees that you see free YouTube videos and get yourself updated or read? Very much yes. It is not under an obligation to train the employees. Yes, it is appropriate that if the new act has come, probably you should train, but there is no the obligating event arises the moment I sign up or enter into a contract with the training agency to train them. Till that time, there is no, at the balance sheet date, no retraining of staff has taken place. Well, that is correct. Then there is no provision needed. Some students say, sir, this is provision for restructuring closure. No. There is no closure, reorganization, restructuring. In any case, this is not linked to closure. This is linked to continuance and hence this will not be a part of the provision. There will be no provision needed since there is no obligation to retrain as of now. So over here, no expenditure is incurred, so no provision is required. Okay, next question 14. This is again a little tricky, this question. We'll do this at the end. We'll do the other questions. Let us go to question number 15. Now, Sun Limited has entered into a sale contract of 5 crores with X Limited during 11-12 financial year. So, this is a sale contract where Sun is going to sell goods. The profit on this transaction is 1 crore. Okay, so maybe the cost of the goods is 4 crores and you are going to sell it at 5 crores. So, there's a 1 crore profit. The delivery of these goods has to take place during the first month of 2012-13 financial year. In case of failure of Sun to deliver within the schedule, a compensation of 1.5 crores is to be paid to X Limited. Sun planned to manufacture the goods during the last month of 11/12. As on balance sheet date, that is 31st March 12, the goods were not yet manufactured and it was unlikely that Sun will be able to meet the contractual obligation, in which case it is not a present obligation, but is it a possible obligation? Yes, out of a contract that you have entered. If it is a possible obligation which is probable, will you create a provision? Yes. Should Sun provide for the contingency? As per the institute, yes. You should create a provision for how much amounts are 1.5 crores. Now Sun can argue that okay, maybe I'll have to pay a compensation of 1.5 crores, I might delay, but I will still sell. And if I sell, I'll make a 1 crore profit. So should I create a provision for only 1.5 minus 1, that is net 0.5? No. Why? Because the goods have not yet been sold. I cannot record a profit on the transaction before the sale actually happening. Should the provision be measured as excess to be paid over the profit, that is 1.5 minus 1, that is equal to only 0.5? No. You will create a provision of the entire 1.5 crores. So we should provide for the contingency of 1.5 crores, and secondly, provision should be made for the full amount. This is, I think, wrongly printed, or it's not properly printed. You should create a full provision for 1.5 crores. Now, question 16 is very similar to question 1, where you have 5 cases where there's a 100% probability of winning 0. Next 10 cases, 50% probability of winning, 50% probability of losing. So you'll give a disclosure at the weighted average amount. Again, the last 5 cases, 50% probability of winning, 50% probability of losing. Again, giving a disclosure using a probability based weighted average. So over here, you can probably try. This is an exam question on your own for practice. Probably over here, it's not properly printed. This is 50%. This is 0. This will be 12. This will be 20, this will be 0, and then again 10 and 21. So basically it is nothing but 0 into 0.5 plus 12 into 0.4 plus 20 into 0.1. This is for one case, there are 10 such cases, and this is 0 into 0.5 plus 10 into 0.3 plus 21 into 0.2. So you will give a disclosure for these amounts. As you can see over here, this is 6 lakh 80, 7 lakh 20, and ultimately 6 lakh 80 into 10, 7 lakh 20 into 5, and that will be shown as a contingent liability, a disclosure, nothing new over here. Okay, next you go to question number 17. Alloy Fabrication is engaged in the manufacturing of iron and steel rods. The company is in the process of finalizing the accounts for the year ended 31st March 22. So you are in the post balance sheet period and needs your advice on the following in line with AS 29. On 1st April 2019, company installed a huge furnace in their plant. Acha, you are in which year? 31st March 22. That is in the year 21-22. Here we have installed a huge furnace in the plant. The furnace has a lining that needs to be replaced every 5 years, which means from 1st April 19, the replacement will happen probably by 31st March 24 for technical reasons. So it's not required by law, but every 5 years you will have to replace. At the balance sheet date on 31st March 22, the company does not provide for provision for replacement of lining the furnace. That is correct. There will be no provision because there is no obligation to replace at 31st March 2022. Even if an obligation arises, that will arise on 31st March 24. In this case, there is no obligation as per law also. But even if it was an obligation as per law that every 5 years you have to replace, you are currently in the 3rd year. There is no provision which is needed, let us say, for the 3rd year. Okay, point 1. Point 2, a case has been filed against the company in the consumer court and notice for levying penalty of 50 lakhs has been received. The company has appointed a lawyer to defend the case for a fee of 5 lakhs. 60% of the fees have been paid in advance and 40% will be paid after finalization of the case. Which means out of the total fees, 60% has been paid. For the remaining 40%, if there's a liability, you can create a provision. 5 lakhs into 40%, that is equal to 2 lakhs. There's a 70% chance that the penalty may not be levied, in which case for the penalty 70% chance it will not be levied. So there's only a 30% chance of payment, and hence your penalty, you will just give a disclosure in the notes. However, for the legal fees, you will have to create a provision if the lawyer has rendered the services. At institute has assumed that they must have. So 40% into 5 lakhs, that is equal to 2 lakhs. You'll have to create a provision for the remaining 3 lakhs you've already recorded. This is what the institute has answered. Now a student might always argue, and rightly so, that sir, should you record it always? Well, that it should be recorded when the legal fees are rendered. If the legal services are rendered, then you can record it. Otherwise, you will record it as and when the services are going to be rendered. Institute has assumed that services must have been rendered, so provision should be made for 40% of the fees amounting to 2 lakhs in the financial statements. Okay, next we go to question number 18. Chaos Limited again is in the process of finalizing accounts for the year ended 31st March 22, that is for the year 21-22. It seeks your advice in the following. Chaos has filed a court case in the year 14-15 against its competitors. It is evident to its lawyers that Chaos may lose the case and it will have to pay 3 lakhs, being cost of litigation. No entries will have been made in the books. So what will I have to do? Well, Chaos is filing the case. It will not receive any compensation, so no disclosure is required. However, a provision for 3 lakhs legal fees needs to be created. Second, a new regulation has been passed in the year 21-22 by the Healthcare Ministry. It is passed to upgrade the facilities. Deadline set by the government is 31st March 2023. Now you are currently in the year 21-22. Deadline is 31st March 23, which means if a provision has to be created, it has to be created after 31st March 23. If you don't fulfill, then there might be a penalty which will be levied. Like when you study income tax, you will study that by 31st July you have to file the returns. If you don't, there will be a 5,000 penalty to start with, and maybe later it can become 10,000. But remember, the obligation on the penalty will only arise once you do not file the return by 31st July. And that is when you can create a provision, not before that. The company expects an expenditure of 10 lakhs for the said upgrade. There will be again no provision to be created on 31st March 2022 for the same. Give your answer for each of the above with proper reasoning. So in the first instant, you will create 3 lakhs for the amount that will be incurred for settling the lawyer, cost of litigation, and under the new regulation, this is the deadline is 31st March 23. On 31st March 22, there is no obligation and hence there will be no provision. Okay, next is question number 19. We have put this for LDR. Let us review this. Saharsh Limited is engaged in manufacturing of electrical home appliances. The company is in the process of finalizing accounts and needs your expert advice. Expert advice, kya baat hai? For AS29. This is again for the year 21-22. A case has been filed against the company in the consumer court and notice for levy 20 lakhs penalty has been received. The company has appointed a lawyer to defend the case for a fee of 2 lakhs. 50% of them have been paid and balance 50% after finalization of the case. Again, 75% chances that the penalty may be levied. Even over here, the institute has said that for the penalty, you will just give a disclosure. But for the legal fees, you will create a expense with the corresponding provision for 50% of 2 lakhs. Now, I would say that your earlier question, I think question number 17 mein, this is similar to question 19 sub point 1. So if you have put in LDR 19, this will automatically get covered. Second, the company is committed to supply consignment worth 1 crore to one of its dealers by the year end. This is, I would say, similar to question 15, not exactly the same. As per the contract, if the delivery is not made on time, a compensation of 15% is to be paid on the value of delayed or lost consignment. If delivery is not made on time, a compensation of 15% is to be paid on the value of delayed or lost consignment. While the consignment was in transit, one of the trucks carrying the goods worth 30 lakhs met with an accident. It was, however, covered by an insurance, and according to the surveyor's report, the policy amount is collectible, subjected to a 10% deduction. So out of whatever 30 lakhs, 10% will be deducted, 27 lakhs will be given. Now, before closing the books of accounts, the company has received information that the policy amount has been processed. So over here, there is virtual certainty. There is virtual certainty. And the dealer has also claimed compensation for the consignment of goods worth 30 lakhs, which was in transit. Now, since there is a delay, you will have to pay to the dealer. So over here, there will be a compensation payable that you will record. This is 15% of 30 lakhs, which will probably come to what? 30 into 15% comes to, I think, 4.5 lakhs. Apart from that, your overall loss is 30 lakhs, which is getting covered by insurance to the extent of 90%, that is 27 lakhs, and hence there is a further 3 lakh rupee net loss which will go in the P&L. So over here, insurance company has approved the claim. 30 lakhs is a loss, insurance claim is 27 lakhs, and hence loss will be 3 lakhs during the current year. And insurance claim receivable will be 27 lakhs. This is virtual certainty exists. They have approved. And compensation claim payable by the dealer, payable to the dealer would be 4,50,000. Okay, so this takes care of question number 19. Now we go to question number 14, the last question. Now this is a little tricky to come in the main exams. Now over here, this is the only case where you don't have a warranty. There is a unlimited right to return. Now when you sell the goods, usually you record sales as per AS9. However, if there's a right of return, then the customer may return the goods later, and hence you will have to create a provision. But provision will be created for what? Well, if the goods are worth 100, I'm selling it at 120, that's a profit of 20 rupees. When the goods are returned, like when you return from Myntra, Amazon, Flipkart, etc., you can only return if the goods are in unused and new condition. That is when they can be returned. So if the customer wants to return later, they will return the goods, in which case your profit will be foregone. Your entire loss is not going to be 120. If a particular good is returned, your loss will be, the profit earlier recognized will have to be reversed. So earlier you had purchased goods at 100, sold it at 120, and hence recognized a 20 rupee profit. Now later, if these goods were to be returned, or let's say 10% of these goods were to be returned, then I will say that I've recorded a profit of 20, 10% of goods are returned, so goods costing 10 and selling price of 12 will come back to me. But have they come back to me? No. Once they actually come back, I will add them to my inventory and reduce it from my sales. But till the time they've come back, I estimate in my past experience that 10% of these goods will come back, and hence I will say that today, if I record sales, I'll have to show the entire sales because goods have not yet been returned. Record sales of 120, record expenses of 100, that means there is a profit of 20. Now, out of that profit of 20, 10% of the profit, that is 2 rupees. Only out of the profit of 20. So you'll have to figure out what is the profit, and based on that, create a provision. You will say that at the end of the day, I'll create a provision because of 2 rupees, because I have currently sold goods which have not been returned. However, in my past experience, they will be returned. And if they are returned, I'll get back inventory worth 100. And hence the profit of 20 that was recorded, of that 2 rupees worth of profit will not materialize. Are we clear with this? Okay. So A Limited sells goods with unlimited right of return to its customers. The following pattern has been observed in the return of sales. Now this is another very important thing, time frame of return from the date of purchase, percentage of cumulative sales. This is not monthly sales, this is cumulative sales. So let us say you are on 31st March. Between 0 to 1 months, this must be sales made in March. Between 1 to 2 months, ideally this must be the sales made in February. However, cumulative sales means February plus March. Similarly, between 2 to 3 months, this must ideally be the sales made in January. However, that is 2 to 3 months away from 31st March. However, because it is cumulative sales, it is Jan plus Feb plus March, and Institute has also done it accordingly. Now the company has made sales of 36 lakhs in January, 48 lakhs in February, and 60 lakhs in the month of March. So if I look at the cumulative sales only from 1st March to 31st March, that will only be 60 lakhs. If I look at the cumulative sales from 1st February till 31st March, this is 60, or rather if I take February first, this is 48 plus 60. And if I look at January, February, March, this is 36 plus 48 plus 60. And hence the cumulative sales will be 60 over here, 108 over here, and probably 144 over here. The total sales of the financial year were 400 lakhs and cost of sales were 320, which means the profit is 80. And if I look at the profit margin, 80 divided by 400, that is equal to 20% will be my profit margin. Now you are required to determine the amount of provision to be made and the revenue to be recognized for the year ended 31st March. Now if the sales have not yet happened, then you will record the full 400 as sales because risk and reward is transferred. However, out of this, we might say that some of the goods may be returned. So for that, you will create a provision. So sir, provision kya hoga? Some student says 60 into 6%, 108 into 7%, 144 into 8%. Remember, this will give you the expected returns. This will possibly give you the expected returns which are likely. You will not reduce them from sales because they have not yet been returned. That is as per the institute solution. 60 into 6% comes to 3.6. 108 into 7% comes to 7.56. And 144 into 8% comes to 11.52. These are the goods likely to be returned. But when they are returned, is the entire amount going to be our loss? No. It is only the profit that is going to be our loss, and hence provision is created based on that. So if I have to create a provision, I will create a provision at 3.6 into 20%. I can take the total as well. 7.56 into 20% and 11.52 into 20%, because this will give me the possibility of the loss of my profit. So if I were to do this, my total provision would ideally come to 4.536. This is the possible reduction in profit. Today I am recording a profit of 80, but out of this 80, possibly 4.536 might be the profit loss when the goods are returned. Currently, you will not adjust the sales or COGS because these goods are sold and the customers have not yet returned it. It is as per the institute solution. So over here you can see 4.536. First, you will have to find the cumulative sales value. Sir, we have not done this earlier because in none of the sums were we given cumulative sales value. You were given total, sales value of each month. Here, percentages of cumulative sales. Likely return percentage and hence likely returns likely, but they have not currently been returned. And iska 20% will be your provision. So 20% is nothing but 80 divided by 400. So sales will be recorded at their full value and total revenue for the entire year will be 400 lakhs, and a suitable provision for returns based on the past experiences, that is at 4.536, should be created. It's a little tricky, this question. It does not come very naturally or intuitively. I really wonder whether people who gave the July 21 exams were able to crack all of this cumulative adjustment, figuring out that you will only have to create a provision for profit, etc. It's a fairly tricky one. But if it comes cumulative and if there is a return, remember provision is created not for the entire sales value, but when you return, one needs to remember that you will have to refund 120, let us say, for example, but you will get back goods worth 100 and hence 20 rupees is of profit that you would had earlier recorded has to be reversed, and only that is the amount for which a provision is needed. Okay, so that I believe takes care of AS29, a fairly interesting standard. Among all the case-based standards like AS1, AS4, AS5 or AS29, I would say this is one of the most trickier standards, and Institute likes asking questions on this. Try to practice as many cases as possible, and I'll see you soon with another topic, another standard. Till then, keep studying. Goodbye, good luck and take care.